Good morning, and welcome to another episode of PwC's Boardroom Forum Live. I'm Warren Gule, and today we're talking about IFRS financial reporting considerations for those entities looking to participate in the voluntary carbon market. As you all know, with the increasing focus on climate change and carbon emissions, companies are starting to take steps to reduce or absorb their carbon emissions. Complete elimination of carbon emissions from operations through mitigation methods is not always possible. So therefore, this drives demand for carbon offsets or credits to offset or part of the remaining emissions generated by entities' operations in its value chain. Now, to discuss all that, and which is quite a mouthful in terms of the topic and the context, I'm joined today by Renita Dwarika, our Africa reporting leader and partner in our corporate reporting services. Renita, I understand that there are two types of carbon credit markets, one being compliance and the other one being the voluntary carbon market. Could you perhaps kick off by explaining the difference between the two markets?
Good morning, Warren, and good morning to our listeners. So first, I want to agree with you 100% that the demand for carbon credits is certainly growing as the focus on climate change is growing. So you ask, what's the difference between a voluntary market and a compliance market? So in a compliance market, Warren, what we find is that companies are granted carbon emission allowances or credits from the government, or alternatively, they purchase the carbon credits in an effort to meet their compliance requirements on carbon emissions because of the territory in which they operate or the industry in which they operate. So there's a clear legal and a compliance reason behind the acquisition. In a voluntary carbon market, which is certainly a market in which we are seeing exponential growth, is one in which companies use carbon credits to meet their voluntary carbon targets. So, for example, an entity may make a voluntary commitment to be net zero by 2030. So, as a result, they'll use the carbon credits to offset the emissions from the operations. Now, if we think about the South African context, companies in South Africa typically do not have compliance requirements. And as a result, we operate in a predominantly voluntary carbon market.
Extremely helpful, Anita. So you have used the term carbon offset or credit a few times and just in the intro, telling us just the context. Perhaps just expand and tell us, what is a carbon offset or credit?
So when I refer to a carbon credit or offset, it is referring to an emission unit that is issued by a carbon crediting program, and it represents the emission reduction or removal of 1 metric ton of CO2 or an equivalent amount of another greenhouse gas. Now, a carbon credit, each carbon credit has a unique serial number, and it is issued, it is tracked, and it's cancelled, all by way of an electronic registry. Now, carbon credit is certified either by the government or an independent certification body, and it will typically take the form of a transferable or tradable instrument. So that's in a nutshell what a carbon credit or offset is.
So there is a bit of an audit trail, I see, in terms of that. I guess consistent accounting practices for carbon offsets is an important topic, right, for companies as well as our clients. So from an accounting perspective, I understand that there are no accounting standards or IFRS interpretations that directly address accounting for carbon offsets and related projects. Is that right?
Yes, that's correct, Warren. So there are no IFRS accounting standards that tell us how to account for carbon credits. However, typically what we do in those scenarios is we apply the existing principles under our existing IFRS accounting standards, and that typically gets us to a sensible way for accounting for the carbon credits.
Maybe just if you can expand on that further for us. So applying the currently available accounting frameworks, how would one account for carbon credits acquired or purchased in a voluntary carbon market?
So Warren, in order to get to the accounting for the carbon credit, it's quite important to understand the life cycle of a carbon credit, because that will help us understand the characteristics or the nature of a carbon credit. So typically, a carbon credit is generated in the voluntary carbon market by what we call the project developer. So a project developer may want to embark on a project of, let's call it planting trees, so forest. The project developer will register that carbon offset project, being the forest, with a carbon offset registry. The project developer will then maintain records of the carbon emission reduction that has been achieved from that carbon offset project. Those records are then certified by an independent certification body, and that entire process culminates in certified carbon credits being registered into the registry account of the project developer. The project developer can then transfer those carbon credits to an end user. And typically when it's received by the end user, it's in a tradable or transferable format, and therefore it can be resold for cash. Now, if we take that context and we apply it to some of the principles in our IFRS accounting standards, we could get to say that the carbon credit meets the definition of an intangible asset. And that's because it's identifiable, it's non-monetary, and it does not have physical substance. And as I said, it is tradable or transferable. On the other hand, it could also be argued that it meets the definition of inventory, where that definition is met. So this could apply to, for example, a broker trader who deals or trades in carbon credits, or alternatively, where the entity uses the carbon credits as an input in the production process.
So it's a toss-up between an intangible asset and inventory. And then earlier on, you mentioned project developer. Can an end user invest in the project developer in an effort to secure carbon credits in the future? And if so, what are the considerations?
So yes, that's a great question, firstly. And secondly, yes, it indeed can happen. So what we would find in this scenario is an entity who then becomes now the investor would extend funding either upfront or over a period of time to the project developer in exchange for carbon credits or share of the carbon credits in the future. Now, clearly, as a result of extending the funding, the investor is now exposed to the variable returns from that project. So exposure because you've given funding, so you're exposed to credit risk potentially. You have upside in that you could receive carbon credits in the future. So in that case, we analyze the terms of the contract to determine what rights the investor gets as a result of extending that funding. So do those rights give the investor a level of control, joint control, or significant influence? If there is no control, joint control, or significant influence, then the second step is to look at the contract to determine whether it gives rise to a lease. So does the investor take substantially all of the output from the project, in this case, the forest? And does the investor have the right to direct the use of that identified asset, being the forest? If yes, then we end up in lease accounting, and that may result in the investor recognizing a right of use asset and a lease liability in their books. If there isn't a lease, then we continue to analyze the contract because we could end up in our financial instrument standard. So potentially with a derivative financial instrument or a non-derivative financial instrument.
I'll be honest, it does sound, that sounds like a complex area in which I guess due consideration and care should be taken by companies and our clients, right? Then would you say that an entity's business model is important to understand in undertaking the accounting assessment? Before you answer, I guess I recall you mentioned inventory a moment ago. It seems like that could be an important consideration as well.
Yes, it is important. So it's quite critical that companies understand the accounting implications before they enter into contracts to acquire, generate, or invest in carbon credits. So as you can see, there's a range of different accounting that can result together with the subsequent measurement considerations, and all of that will be driven by the business model and the rationale for holding the carbon credits. And then, as you can imagine, Warren, the accounting policies around these become so important. So companies need to develop an accounting policy. They need to ensure that it's consistently applied to similar transactions, and then it's appropriately disclosed in the financial statements.
And I guess making sure that it's appropriately disclosed in the financial statements, the role or business model of an entity would also influence the cash flow statement, right?
Yes, very hot topic, and definitely a focus area for our regulators. So the classification in the cash flow statement will be driven by how the carbon credit is classified when it is acquired. So if it's classified as an intangible asset, then our IFRS accounting standards tell us that cash flows relating to the acquisition of long-term assets, and an intangible asset is typically a long-term asset, should be reflected under investing activities. But sometimes in the carbon market, we find that companies acquire the carbon credit with the intention to retire it within the next 12 months or within their normal operating cycle, in which case you could build an argument to say that it's a cash flow from operating activities. Then where the cash flow is, or the acquisition of the carbon credit is treated as the acquisition of inventory, then typically cash flows relating to inventory goes through our operating cash flows.
Okay. So the distinction between cash and non-cash in this instance is quite important from what I gather. So for example, I might have paid for the carbon offsets entirely in the current financial year, but only receive the offset in the subsequent financial period. But additionally, the cash flow statement would only then reflect the effect of the transaction within the period when I physically get paid, right? Am I right in my thinking?
Yes, there? Yes. So you're on the right track, Warren. So it's very important that each cash flow reflected in the cash flow statement can be tracked to a genuine cash flow. So in other words, in your example, where I extend the funding upfront for carbon credits in the future, then when the money flows upfront, it is that cash flow that is recorded in the cash flow statement, potentially as an investing cash flow. In the later periods when I receive the carbon credits, that is a non-cash flow transaction. And as a result, it would not feature as part of the cash flow statement. However, it could be a significant non-cash flow transaction, which would require further disclosure in your financial statements.
Wow, Renita, I think that's quite interesting. I really enjoyed the perspective. And I guess, as with good things, we're at the end of our session this morning. Perhaps any last or final comments from your side?
Definitely, Warren. So for reporting purposes, my advice to board of directors and audit committees would be to firstly understand the market in which you are operating. So is it a voluntary market or is it a compliance market? The second thing is then to evaluate the accounting policies that are being put forward by management to ensure that it aligns to the business purpose as well as the rationale for holding these carbon credits. And the last thing I would say is evaluate and assess the key judgments and estimates relating to the accounting for the carbon credits and ensure that those are appropriately disclosed in your financial statements.
Excellent. I think a very complex topic, but Renita, thank you very much for making it easy for us to understand understand the important aspects of the topic. To everybody that's joined us this morning, thank you very much, and we look forward to seeing you on our next session.